Hello and welcome to our Hightower Signature Wealth monthly fireside chat. Our mission for today is very simple. We provide our respected clients not just with insights, but more importantly with perspective and best practices to investing. My name is Matthias Kuhlmey. I'm the Chief Development Officer of Hightower Advisors. With me is Stephanie Ling, our Chief Investment Strategist and Head of Investment Solutions, and she as always brings decades of institutional experience and a fundamentally grounded approach in navigating our complex markets. Her insights, I think, are always there to help us to spot the proverbial signal in the noise, especially when it comes to complex markets. And today's goal is simple: discuss real opportunities and clarify the risks that matter. Stephanie, we talked yesterday in preparation, and look, this year has started a bit challenging with some surprises. And at the same time, there seems to be a fundamentally strong economy. Kick us off. What are your current thoughts?
Yeah, so it's great to be here. It's great to do this with you, Matthias. I
Of
always
course.
enjoy chatting with you. I think that the most important takeaway is that the economy is actually running above trend, and it has been for the last several years. We have been gaining momentum post COVID because there has been an enormous amount of fiscal and monetary policies that have been put in place. And we had to do that during COVID, of course. We closed the world down. But even post, we kept adding all these policies in place, which has led to a lot of momentum. There's a couple things that I am watching right now. Currently, GDP is running at about 4%. And that is led by a couple of different things. Number one is the consumer. The consumer, believe it or not, is consuming. And the reason they are consuming is because they have jobs. Now, I know the labor market is cooling. It absolutely is. But we can get into all the specifics if you like. But I look at the weekly jobless claims, I smooth it out, and we are at very low levels. That's a good thing. The lower, the better in terms of weekly jobless claims. There is one job available in the country for one unemployed person. In addition, not only do they have jobs, but wages are running at about 3 to 4%, and inflation has come down. It's not where the Fed wants it to be. They're targeting 2%. It's running at about 2.5 to 3, no matter depending on which metrics you look at. But it's come down from the 9.1% level that we saw during COVID, or just post-COVID, rather. So you have all these things happening. And if you look at kind of credit card data, which is what I look at, because that's like the real time in terms of spending, and you're running anywhere between Chase and American Express credit card data, running at about 4 to 6% growth in spend. And in fact, Bank of America just was at a conference. The CEO was talking about spending, and spending in the month of January alone was up 5% year over year. And they do not see any deterioration in terms of delinquencies and that kind of thing, pressure. They don't see it. And I have to tell you, I counted during earnings season, the banks, when they said the consumer is resilient, it was 25 times for 6 banks. They kept on saying that the consumer is resilient. Why do we even care about the consumer? Because it's 70% of GDP. And what they're spending on is mainly services, some goods, but mainly services. And why do we care about services? Well, that's 75% of consumption. And what exactly is services? It's restaurants, it's hotels, it's travel, leisure, that kind of thing. So that's one piece of why the economy is doing better. The second piece is not going to surprise you or me or probably anyone on this call. It's all about AI. And there's more to it than just the Mag 7, meaning the big technology companies spending. They're spending a lot. Matthias, we talked about this yesterday. They're
Yes.
going to spend $761 billion this year alone, up 75% on AI. But there is a food chain that actually is really benefiting the economy. And that is, if you believe in AI, you need data centers. And we only have 11,400 data centers in the world. We probably need something closer to 30,000 by the end of the decade. If you believe in data centers, you need to have a better electric grid. And we have 75% of our grid around the country, is over 25 years old. And then, of course, you need power, and we don't have enough of power. So all of those, what I call the food chain, is driving
Yeah.
substantial growth. And it's also not only leading to growth, but better productivity. We've seen productivity at about 4.9%. Again, I mentioned inflation is coming down. That's kind of Goldilocks when you have better productivity and lower inflation. So all of these things have led to above trend growth. That above trend growth, Matthias, is 1.5%. I mentioned it's running about 4. Even if it's 3 or 3.5, it's still better than what we have been seeing. And the one last thing I would point to is the one big beautiful bill. Whether you think it's beautiful or not, there's more stimulus coming, and that should help not
That's
only
right.
the consumer
That's right.
but corporations. And if you add up one big beautiful bill and all the fiscal and monetary policies that are put in place, that's about $1 trillion in additional stimulus, or 1% of GDP. So we shall see how it all evolves. We shall see if we can get inflation really to that 2% level. I have my doubts. I know you do as well. But right now, so far, so good. And I would just end by saying, why do we care about macro? Well, we care because it feeds directly into earnings, and
Yeah.
earnings running up double digits. And my good friend Larry Kudlow taught me 18 years ago, stocks follow profits on the way up and on the way down. And right now they're getting revised, and they have been getting revised over the last 3 years. And that's why the markets, the S&P, has done so well.
Stephanie, thank you. And I found it interesting. You took it all the way back to COVID. You described an economy that was accommodated heavily because we had to accommodate
Yeah.
heavily. And sort of the spooky elements that the market was scared about seem to disappear. And I want to sort of just provide a quick summary. Economy now is resilient, not accommodated. Inflation is trending lower. Earnings growth is strong. And then the big, beautiful bill, fiscal policy, also provides tailwind with implications for GDP. And yet, when we talked yesterday, it was interesting. The market doesn't seem to trend around the same darlings. And you said, well, look, this is a stock picker's market. What are your thoughts there, Stephanie?
Yeah, so for the last 3 years, the Mag 7 and technology have really been the leaders. In fact, last year, 90% of the returns in the S&P 500 came from the Mag 7. That's a very concentrated environment. Technology is 35% of the S&P 500. Technology did well as well. And I think this year you're starting to see a broadening out beyond technology. And I do not think that the Mag 7 are dead on arrival. I think they're amazing companies. I own a few in my portfolio. I just think they're taking just a pause here because they're spending all of this money. And some companies, by the way, Matthias, are even going into the debt markets.
Right.
And I don't like that at all. But as a result, the free cash flows are stalling at these companies. And I think that's kind of the thing that's bothering investors. I know it's bothering me. And so they've had a nice run. They are still expensive, even though they've come down in terms of multiples. But now, at the same time, you have a broadening out into other sectors because of what I mentioned in terms of the economy. When the economy is growing above trend, you tend to want to own companies that benefit from the better growth, meaning what we call cyclical companies. And so the industrials have done very well year to date. Energy, materials have done well. Some discretionary. Housing has all of a sudden caught a bid. And so I do think it's a stock picker's market. I also think it's a broadening out market. And I look at the S&P 500, the equal weight. Everything is equally weighted in the S&P, all the names, and it's up 6%. And you look at the S&P 500, which again, I said is very heavily tilted to technology, that's actually flat on the year. So that tells you that there's a shift going on. It's not all or nothing, but it's a little bit more of everything.
Yes, definitely very interesting. It was a good prep debate we had yesterday, leadership broadening.
Yeah.
You know, there is a world beyond the mega tech companies. And you stated this may actually make this year different, right? You want to hold on to the theme, but want to not go into, I call it sort of the crowded trade or investment. Stephanie, this in mind, let's briefly go back to AI. You had mentioned it, in terms of the infrastructure. Yesterday, however, we also talked, and you had very good points. There are jobs, they're not even available. There are things happening on the wave of AI that we need to see play out. Enlighten us with your thoughts there.
Yeah, so I would actually suggest that anybody who's interested to actually go online on CNBC.com. And there was a wonderful interview back in November. Tom Fanning, who is the ex-CEO of Southern Company. Southern Company is a utility company. I don't own the stock in full disclosure, but I always enjoyed listening to him because he always has his finger on the pulse of what is going on in the world of anything electric and electricity centric and power and that sort of thing. And he said he didn't think that we were in a bubble because that was the talk back in November. Are we in an AI bubble? And he
Right.
said, no, I don't think we are because we don't have enough people. We don't have enough sophisticated people that are working on, kind of pipe fitting or the electricity or on windmills, etc. And so that is something that I think is really very interesting because one of the questions that I get from a lot of advisors and a lot of their clients is AI, it's all great in terms of efficiency, productivity, growth, and cost cuts for companies, but what is it going to do to the labor market? And then you actually had said this, there's a whole different kind, like there are jobs we don't even know exist.
Yes.
So I don't think it's going to be all or nothing that everyone loses their job and there's no replacement. It's going to be different jobs that are going to be in demand. Excuse me, you had mentioned just being an influencer. Influencers didn't even exist 5 years
Right.
ago. So I think
Right.
that we have to be careful not to worry about the labor part of things. It's certainly something to watch. There's no question about it. I said it's 70% of our economy is the consumer. But right now, I think that there are going to be some puts and takes. And in the meantime, you go back and look at the dot-com bubble. Everyone was nervous that the internet was going to take jobs, and there are so many different jobs that came about, namely cybersecurity jobs.
Yes. Yes. And we had also an interesting touch on our industry, finance. There was sort of a
Yeah.
bit of a shock market event with
Yeah.
the fear that finance companies will lose out to AI. And when we discussed yesterday in our prep, it was interesting to see AI is also the opportunity to actually bring human quality, more human interaction to our clients and sort of focus on the outsourcing of commoditized processes. I don't think we know today how this will play out. It's quite interesting to watch. Um, so when
It's
we spoke, is AI deflationary or inflationary? Who knows at this point?
No, I know. I would lean towards it. It's probably deflationary, number one, but in certain industries, you're going to see inflationary impacts as well. When there's a lot of demand for something and there's not enough of it, like meaning people, I mean, that could create wage growth and wage opportunities. I think we still have to see and really and wait and see. And I think in our industry, you make a good point. Look, I think that advice and perspective and talking to a person one on one
Yeah.
and that feel factor is so incredibly important and underappreciated. And so, sure, our entry level jobs within the financial services industry, we're already seeing it. It certainly is some of AI is replacing some people, not all. I will tell you that there is always a market for really hardworking people, really
Yeah.
people that make it so that your job is that you support and you help other people around you, and so that you do more than what you're asked to do. Like an overachiever, people always want overachievers. AI is never going to do that for you, in my opinion. But I
Right.
do think that generation, the Gen Zs and below, I think they're going to have to be more creative, and we'll have to see how it all pans out. But I think you will always need people to talk to. And I would say that AI, it's like embrace it. Make it help you be smarter. I know
Yes.
I do research
Yes.
every day and it makes me smarter. And like I go back to the pipe fitting comment from Tom Fanning. I heard him say, well, we don't have enough pipe fitters. And I didn't even know what a pipe fitter was. So I go on in AI and they give me this whole thing. And how do you build a pipe fit? I mean, it really is quite amazing. So it goes back to productivity. And I think, again, we should embrace it and make us smarter.
Yes, definitely. Love that notion. You were speaking about Gen Z. We were covering the tech sector, the mega trend that has been unfolding.
Mm.
Allow me to build the bridge on that note into another darling asset, quite volatile these days, digital assets or crypto.
Mm.
What is your thinking today? And as I said, we had quite a powerful, not so pleasant year.
No.
Where do we stand from your perspective? What are the opportunities and risks?
So I think that Matthias, and you were early on in crypto. I mean, this was 6 years ago. You were already involved 5 years prior to that. When I remember you
Yes.
and I, when we first met, we would talk about it, and I was like, I don't know. And I've really come around to wanting to have exposure, and it goes back to maybe not my generation, our generation. Some are
Yes.
some are participating in it, but it really is the Gen Zs and the younger generations that are embracing crypto. I laugh all the time because my daughter would rather own crypto than stocks. And I told her she's not allowed to come back from college if that's the attitude that she has. Kidding around, of course, but
Yes.
noticing it's not just her. It is a generational change in terms of wanting to have exposure. Not all, not nothing, somewhere in a balance. But I have come to the conclusion that I don't know how to predict crypto prices, Bitcoin. I don't know if anyone really does. I do know it's a risk on asset. It does tend to trade with technology, software, unprofitable tech. It's a risk on asset. And we've seen risk off this year in terms of all of those segments. So you're going to have fits and starts. The way I'm embracing it is I don't really need to know what the price is going to be. I want to own an exchange. I think that you want an exchange, a buyer and a seller. That's all you need. You don't necessarily need to know what the price is. And so that's where it's kind of my chicken way of investing in the concept. But it is something that it's very volatile. And so it's always very, very important if you're going to have exposure, it to be a small, either small or something that you're comfortable with, because it does have these wild swings.
Yes, Stephanie. And two things there. What you're really stating here is I don't know how to get the price right, or more importantly, I don't need to get the price right because I invest in the marketplace to capitalize on clearly a trend that is a given. You
Yes.
you reminded me, in fact, of our conversations 5, 6+ years ago, and I want to go back because I remember what you said when we spoke about Bitcoin. You said, I buy copper. I'll take this trade over Bitcoin. I think it brings us beautifully into sort of the commodity space. What is your thinking there in terms of where the world stands around real assets?
Well, I mean, I think this year you actually have been seeing definitely last couple of months, and have you been seeing commodities do better? And then we can also talk about international markets if you want to as well. But
Yes.
commodities have actually done better because not only is is the U.S. growing above trend, but global growth is actually has improved, and that is because over the last couple of years, not only has our central bank been very easy and accommodative in fiscal and monetary policy. You've had other central banks and other governments doing the exact same thing. And so you are starting to see a little bit better growth around the world. And if you believe that, then commodities ought to do a little bit better. And we have seen copper do very well, gold, silver, platinum, palladium, all kinds of commodities. Even energy has caught a bid as well. So I would say I'm most bullish on copper. I still am. So 6 years later, I'm still bullish on copper because
Yeah.
there just isn't enough. Copper demand is going to grow 2% per year given the tight supply, but also because it ties directly into all the things we just talked about in terms of the grid and data center build out, EVs, and as well as housing. And I'm a housing bull. The number one commodity that goes into a house is copper. So I like copper. Gold, I think we could talk hours about gold, but gold tends to be a hedge, or also it gets influenced by central bankers in terms of where they're allocating assets. And I do think it ties into the whole international story because last year, the US was, while we had a good year, up 18%, it was one of the worst performing regions in the world. All the other international markets did a much, much better. And again, it's all because they're growing more. But I think you had central bankers on the margin and investors on the margin selling selling US treasuries, buying other assets, maybe including gold as well. Silver is a little different animal because 60% of silver is industrial demand. And so what we've been talking about in terms of AI build out, that kind of makes sense. Does it make sense that it was up at 1.95%? No, not in my mind, but there's always extremes. But I do think you could have commodities in a portfolio this year. I certainly have increased the exposure as well.
Right. Stephanie, and that brings us once again, excuse me, to another topic, commodities and infrastructure exposure tied to AI. We were actually talking about it, but I want to bring you around to the previous topic. The central banks, their accommodative policy, there has been risk or talk about a weaker dollar. Let's also tie this into your thoughts about, trade policy and tariffs. That has been a big theme for weeks and months. What is your current thinking, Stephanie?
So I think tariffs have actually worked because the whole point of having tariffs is so that we could incentivize companies to build here and to manufacture here and to grow here and increase jobs here. And I think that has done a lot of it, not all of it, but it's certainly started the ball rolling. We're going to actually get about $350 billion from tariffs alone. We'll see what the Supreme Court rules, but overall, the motive and the message was take your plants and manufacturing from overseas and bring them here to the United States. And it hasn't led to inflation. A lot of people thought it was going to lead to massive. Okay, so maybe inflation's a little stubborn at 2.5%, 3%, Matthias, but I would argue we're actually seeing a little higher inflation because we have better growth. And I would take better growth and a little bit more inflation any day. So yes. I think that, a lot remains to be seen, but our companies here in the United States, they've done a masterful job at navigating through tariffs. And now, in April and May, when the tariffs last year were announced, we're going to anniversary that. And not only have the companies actually been able to deal with it and find offsets, but now they're going to roll off this big headwind as well. And then in terms of the dollar, yeah, sure, that kind of coincides with why central banks and investors kind of sold some U.S. stuff and bought other international stuff. And that weakened the dollar last year about 9%. I would argue there's an inverse correlation to earnings and the dollar. So the dollar goes down and the S&P 500, because they have 70% of their sales, most of them outside the US, a weaker dollar is a better translation for them. I don't know if we necessarily pay for that, but in terms of a multiple, but that's the point. The point being is that earnings were not hit last year despite the dollar. And the one last thing I would say is on the dollar, watch the velocity of the move. If it kind of dribbles down, 5, 6, 7, 8%, okay. Watch it. Why is it going down? But if it were to go down 10% in a day, that's where I think things would get a little bit more scary for sure, because then something is in the system that's uncomfortable and worth watching.
Makes sense, Stephanie. So when we look back to the tariff debacle and the volatility that happened as a result in markets, it seems like today most market participants were not right. From your perspective, where is the market mispricing risk today? What's a opportunity that we should be thinking about?
That's a good question. It kind of goes to all my worry points. I think overall volatility this year is already high, so I want to watch that. It's again just like the dollar. It's kind of creeping up every day. I do worry a lot that the Mag 7s are very crowded. In fact, 75% of institutions own Mag 7. And what I have heard from advisors and their clients is, yeah, they participate too. They all own Mag 7 as well. And they're not selling because of these huge embedded gains. I don't know what that really means. I do know what it means, but I don't know how does that manifest itself over time?
Right.
And look, everyone's sitting on enormous gains over the last 3 years. You and I talked about it. We were up 18% last year, 24% the year before, and 23% the year before that. The long-term average is 7.7%. So maybe we're due for just a pause. And if Mag 7 can't get its act together, we probably will see a tougher time overall on the markets. And what kind of frustrations does that lead to from people that own these stocks and they don't participate in what's going on elsewhere in the market? So, I mean, I have a list a million pages long, honestly, of worry points. I worry when I don't worry, Matthias, because obviously that means we're
Yeah.
complacent, right? But I
Yeah.
just think like if you focus on fundamentals and you just do a lot of reading and you do a lot of homework, it's you can learn a lot and you can feel a lot better.
No, thank you. I love the list of a million points. I think I share the same. We should compare notes at one point. And you also said, just to take us back a bit in the conversation, you don't need to be in the Mega 7 in order to participate in certain important trends that are playing out. Stephanie, I'm coming to the last question. We have addressed your list of worries, the wall of worries.
Yeah.
What is the biggest opportunity over the next 6 to 12 months that you're looking for? Something you have on another list and say, I'm capitalizing if it comes to a certain price, to a certain level, if a door opens. What are you thinking about that is exciting to you?
There's so much that's going on with regards to all the AI and the data center and all that. I think the industrial sector is in a renaissance right now, meaning those that are building the data centers, those that are helping the grid and improving the grid, those power companies that are also helping to fuel all of this stuff, which we just don't have enough of. I've not seen backlogs and orders from industrial companies like we are seeing right now. And again, it goes back to if we don't have enough people, but we have the orders, the visibility to earnings and revenues for the industrial companies is enormous. I'm just going to throw out a stat on a company called Vertiv. They make cooling systems inside the data center. And I'm just mentioning it because they had orders up 200% year over year and up 152% sequentially, quarter over quarter. I've never seen such a thing in my life. So I'm very excited about that. Are the stocks cheap? They are not. Have they run? They have. There's the one, though. Those are the sectors that the sector that I like a lot. The other sector, I'll give you two more really quick. The other sector is financials, because financials have actually been very disappointing. But they're at the front line. If you think the economy is growing above trend, and if you believe me, and you think that the consumer is going to hang in and part of corporations and industrial manufacturing is going to do well, they're going to see it. And what's interesting is we're starting to see capital markets activity increase. We're starting to see M&A activity. I mean, fees for M&As for the big six banks are going to be up 37% this year. That's enormous.
Incredible.
And when you listen to Goldman Sachs or Morgan Stanley or Bank of America, these CEOs at these conferences will talk about pipelines that they haven't seen in over 5 or 7 years in terms of M&A and IPO activity. And then if you add on deregulation, which is another part of the Trump administration and what they've been trying to do, they're going to be much less strict on the bank's capital levels, meaning how much cash they have to hold, because they had to because of the great financial crisis. So they have been under enormous regulation since 2008, the great financial crisis. And I think that's going to start to ease a little bit. So the big six banks have $176 billion in what they call excess capital, stuff that they can give out, right? Loan growth and buybacks and dividends and everything else. Once the regulations come out this year, that number goes to 250 billion. And so to me, I think the activity and the earnings will go higher. And then the last thing I would say is we're starting to see it. I was so excited to tell you about this because I know you know, I've talked about this before, but housing is starting to catch a bid. In fact, the 30-year mortgage is at 6.01. So 2 years ago, it was at 8.06. If you get, so I'm so excited about, we're growing above trend. We haven't even had a housing cycle. So if you get mortgages to the mid fives, low fives, I think you're going to see a lot of demand, pent up demand across the spectrum. And the reason from the economy why we want housing to perform or outperform is because it's a multiplier effect. When you buy a home, you have to buy stuff inside the home. You buy stuff outside the home. Believe it or not, auto sales are tied to a home because you got to buy a car to get to wherever it is you're going to go, maybe building out those data centers. So the point being is we root for housing, and we're starting to see a little bit of signs. We're 4 million homes short in the country. So it's not really a demand problem. There's one in 7 Americans that want to buy a home. But 71% say it's just an affordability issue. So we got to get the mortgage rates down and we got to get the pricing down, but we're starting to see little green shoots as well.
Yeah. Stephanie, thank you. I think we covered the world in a nutshell. It's fantastic to speak with you, to hear your valuable insights. Thank you for everyone listening and dialing in. This is Hightower Signature Wealth and our monthly fireside chat. Join us again with Stephanie Ling, Hightower's Chief Investment Strategist and Head of Investment Solutions. Thank you very much.
Thank you, Matthias.